Alrighty, looks like we're live. I'm just going to open up the stream on my second monitor so I can monitor things. So if my eyes are glancing into the top right, that's what I'm looking at. We'll just wait a couple of minutes for people to trickle in on the stream. So this is being streamed across both LinkedIn and Twitter. So hopefully we'll have a bunch of people joining, and then we'll get started probably like 2 minutes from now. That's what I'm looking at. Alrighty, looks like we have a few people on LinkedIn at the moment. Let's check how Twitter is doing. I feel like Twitter live streams are very underused. There's probably a lot of interesting stuff that a lot of companies can be putting on there. Cool, so we're live on Twitter as well with, I think, a handful of viewers. So we'll maybe give it 1 more minute and then kick things off. If you've just joined us, then welcome to the live stream. We're just waiting for a few more people to trickle in before kicking things off in just a few seconds. And we're streaming across LinkedIn and Twitter. So you can, if you're on Twitter, you can post questions and comments just in the reply to the tweet. And if you're on LinkedIn, then there is actually a live chat. So feel free to engage with us there. Cool. We are now 2 minutes past the hour, so we'll kick things off. So hello, everyone, and welcome to this live stream. The topic today is the importance of business and personal planning. My name is Taimur Abdaal. I'm one of the founders and CEO of Causal. Our product is a business planning and financial modeling platform for modern teams, mostly startups, but also some later stage companies. We have a really exciting session today. I'm joined by Jordan, who's the CEO and co-founder of Compound. Compound is a wealth management platform for tech employees, and I'll give Jordan the chance to introduce himself properly in a sec. But first, I just want to quickly introduce today's session. Here at Causal, obviously, we mostly work with businesses and finance teams. Our product helps companies do financial modeling, financial planning, business planning, whatever you might call it. And so we have a lot of data on kind of the business side of the table about how companies currently do financial planning, what the problems are, and really how companies can get to best practices when it comes to planning and modeling their businesses. We were chatting to Jordan a while back, and we were kind of thinking, why don't more people think about their personal finances in the same way, or kind of manage their personal finances with the same sort of level of intentionality as businesses typically do this. And so that's kind of what we'll be talking a lot about today, about how you can kind of take almost like a business-minded approach when you're thinking about your own personal finances. And so that's what we'll be digging into. Before I hand the mic over to Jordan, just in terms of an agenda and some ground rules, as I mentioned a few minutes ago, we do have a live chat on LinkedIn, and you can reply to the live stream tweet on Twitter. And so if you have any questions during the live stream, please drop them in those chats. We have those up here on our side, and so we'll be answering questions throughout the live stream and then a bunch of questions at the end. We'll talk a little bit at the beginning about kind of the business side of the table and how companies and startups should think about financial planning and financial modeling, and then we'll switch over and talk about the personal side of things and kind of bring those two worlds together. So we'll kick things off then. Jordan, I'll hand over to you. Would love to just get a quick intro on yourself and Compound.
Definitely, and super happy to be here. Thanks for helping set this up to the Causal team. My name is Jordan. I'm one of the founders of a company called Compound. My background is primarily in software engineering and writing. I helped start the company a few years ago, mainly because I didn't understand my finances, and kind of more traditional providers and advisors out there, I felt like also didn't understand my needs. So what we started at Compound is a financial platform specifically designed for people who work at tech companies, so startup founders, employees, investors. And what we specialize in is helping these people really obtain peace of mind with their finances. We help them track their assets, invest their money, file their taxes, borrow money, etc. And why I'm excited to chat today, and kind of one of our foundational beliefs, is that similar to companies who have what I'd call kind of a CFO job to be done, they hire finance teams, accounting teams, they manage their treasury, plan, etc. We think people, especially people with complexity who kind of exist in the technology ecosystem, actually have a very similar job to be done, and need help managing their finances and are often really left in the dark. And that's kind of what we're particularly passionate about, is bringing transparency and information to people who are in that position today where Investopedia articles don't make a lot of sense. They're seeing random acronyms pop up on Slack, and they're looking for kind of more clarity around their financial life. And the last thing I'd say is as we chat today about companies' financial planning, personal financial planning, I think it's also worth calling out that there is some intersection where, as an employee, I own stock in a company where I need to be thinking about the financial future of that company. As a company, I need to think about how to compensate my team and educate them and communicate to them. And I think that intersection is where we're kind of starting to see a lot more communication and transparency. And I'm really excited for that part of the future. So yeah, that's a little bit about Compound. I'm really, really excited to maybe start with learning more about how Causal and team really think about where financial planning broadly fits into the job of a startup, and perhaps how that evolves and changes over time as well.
Yeah, absolutely. That was an awesome introduction. Thanks so much. I really wish you guys were also live in the UK over here, because yeah, just the whole world of like personal finance, it's pretty complex at this point, with sort of cash and equity and probably a bit too much crypto and all this other stuff that I think pretty much everyone is dabbling in these days. So excited to dig into that. I mean, yeah, just I think on the business side of things, I think a lot of people, if you're an early stage founder, or you're someone without a finance background, I think a lot of people might not appreciate the value of actually planning when it comes to your business. And I think kind of one of the fundamental insights that got me and my co-founder to start taking this stuff more seriously, we're not actually from finance backgrounds ourselves, we're from more of the sort of tech and math side of things. The insight that got us to take planning more seriously is that actually, whether or not you explicitly write down your plan, there is still some kind of plan in your head that you will be executing against. Whether you write it down or not, you are going to be doing stuff. And so depending on the stage of your company, this matters to different degrees. So, at a really early stage company, maybe it's kind of just the two founders, you barely have a product, you're trying to get initial traction, definitely don't have product market fit. The plan in your head might be something like, look, I'm going to spend most of my day on LinkedIn messaging people to try and get demos booked for my tool, my product. I'm going to do those demos. We're going to build whatever features we need to close those deals, and we're going to rinse and repeat. That's what the day looks like. It's doing demos, trying to close deals, outreaching to people, and that's how we're going to push the product forward. That's how we're going to push the business forward. And we're not going to worry about hiring or all this other stuff until we reach, say, 200, 300K ARR, and then we'll take a step back and start thinking about things. So that might be a plan if you're just a couple of co-founders in a business, and that's probably a decent plan for a two-person company trying to get off the ground. You probably don't necessarily need to write that down. I think writing it down probably won't change your day to day. You kind of just need to crank it out. You need to get the reps in. You need to do the grind, right? Now, once your company gets a bit bigger, say once you have 10 people, maybe you have product market, you're kind of getting to product market fit. You definitely have some revenue. You've got some customers. These 10 people are working across different functions in the business. They might have slightly different priorities, which need to feed into each other. I think this is kind of the middle ground where I'd say most companies don't have too much of a plan written down at this kind of 10 people approaching product market fit stage. Once again, whether or not you have it written down, there will be something in your head that you're executing against. So there is some kind of plan. And I think this is kind of an interesting middle ground where if things are going really well, if all the numbers are just going up and to the right, you're probably fine without a plan. You'll get your next round of funding. You just need to keep executing, keep cranking it out, keep growing the business. I think if things are only going okay, or God forbid, if things are going badly, then it's actually possible to accidentally run out of money, which happens surprisingly often. And the value of planning, I think, at this stage is basically to see that coming and not accidentally run out of money in your business. And so that's kind of at the edge of product market fit, about 10 people, at the edge of like seed to Series A. Once you're really in scaling mode, let's say your company is about 50 people, you now have a lot going on in the company, right? You're probably spending like $8 million a year on salaries. You're probably spending $500,000 to $1 million a year on software and cloud. These are not small numbers, right? You'll probably be trying to double or triple your revenue over the next 12 months. And that's not something that happens accidentally. It's, the founder cranking out more demos is not what's going to triple your revenue over the next 12 months. And so you can't just be doing the same thing you were doing the previous year. And so now, the value of planning is still, hey, we're not going to run out of money accidentally because we have a plan. But now it's also about helping you have a credible strategy to hit those revenue goals that you might have. A plan is how you actually come up with that strategy and know whether it might work. And your next funding round will be dependent on that. And then it's also about aligning your team, right? You've got these 50 people, and you kind of want everyone to be moving in the same direction. So I think the sort of value of planning is different at different stages. I think at the really early stage, we've definitely seen lots of companies fall into the trap of like, not having a product, but not really being off the ground, but spending a lot of time building like a 20 tab Excel model. Definitely don't recommend that. I think at the super early stages, plan in your head's probably fine, maybe some rough calculations. So once you have more people, once you're generating revenue, it's like I said, surprisingly easy to accidentally run out of money. I've actually, over the past couple of months, spoken to multiple finance people, sort of finance FP&A people who joined, some of these super high growth companies, that raised 3 rounds of funding in the last 2 years, massive headcount growth, really, really hot companies. And I think in the climate of 2021, these companies didn't need to worry about their burn too much. As long as their revenue roughly kept going up, they know that they'd have the next round of funding, 6 to 12 months down the line. That's definitely not the environment we're in now. And actually, the first thing that these finance people who I'd been meeting with did once they joined these really hot, fast-growing companies was to look at how much money was being spent. And within their first couple of months, they kind of realized, damn, we're burning way too much money and we need to lay off people. And so within a couple of months of hiring their first finance people at these companies, they ended up having to do layoffs despite having, 30 million plus in the bank and despite being really hot companies because they were on track to accidentally run out of money. And so I think kind of the most bare bones value of planning is to stop a company from accidentally running out of money. Once you have kind of product market fit, planning, I think the value that it adds on top of that is to actually help you figure out what your strategy is going to be for hitting your revenue targets and actually scaling the business. And then once you have a sizable team, a few dozen people, planning also is how you make sure the team is aligned and everyone's kind of rowing in the same direction rather than different people targeting different things. So I think that's kind of how I think about the value of planning. Does that kind of make sense at a high level?
Totally makes a lot of sense. I think what I take from it is, and definitely some overlap in how I think about kind of personal planning, but in a lot of ways, there's all of these kind of implicit assumptions that people are making in their business. And when you make them explicit, there's the value of just visualization of seeing them, but also that you can really, implement the impact of making something explicit and really change strategy or save your business or improve your likelihood of success kind of in the future. And another thing I think you make really clear, but it's worth kind of underscoring, the job of the founder, the job of the leadership team, I think first and foremost, and in a lot of ways, or at least one of the top priorities is to make sure you don't run out of money. And perhaps in previous years, that was kind of taken for granted as this thing that was not actually that hard. But it turns out that is actually a non-trivial thing that you need to plan for and make sure that you're aware of exactly kind of what your burn is and when you may run out of money. Does that kind of make sense?
Yeah, no, absolutely. Yeah, I think we're just in very different waters than we were in the past couple of years, and I think we at Causal and sort of the companies we work with and generally the ecosystem, I think is doing a bit of a mindset shift towards more planning, more budgeting, watching burn a lot more closely. I think a lot of people probably have a basic sense of like, hey, when we build a plan, we'll have some kind of spreadsheet. Maybe we'll start with a template which we find online. Maybe our investors will send us like some template we can get started with, and we'll need to like fill in some numbers and figure some things out. I think most people have kind of a basic sense of what that process looks like, and there's lots of stuff online about how you can set up a financial model or set up a financial plan. I think some of the things that we don't see emphasized enough, I think are actually pretty key. So I think one easy trap to fall into is you get this really nice template, you fill in the numbers, investors are happy, you've got this plan, but then I think a lot of people kind of forget to track how accurate their plan or their forecast actually is. So on a monthly basis, I think it's actually pretty important to look at, hey, this is what the plan was, this was what we were targeting, this is what we actually did, so this is how much money we actually spent on salaries or software, whatever it might be, this is how much revenue we actually generated, and really trying to understand why there's a difference there, if there is a difference. There's probably going to be a slight difference. I think it's easy to forget about doing that exercise. You're super busy, everyone has lots of other priorities, but it's actually a very valuable exercise to look at the difference between what your plan was and what actually happened, and try and understand why there's that difference. Things very rarely go according to plan for startups, and so it's worth kind of keeping to iterate on that. Otherwise, you kind of end up in this position, you build this plan, 3 months down the line, the plan is actually not at all accurate anymore. So you stop looking at the plan because the numbers are going to be wrong. And now you've kind of lost the value of having that plan. So it's more of a live, continuous thing. And at least on a monthly basis, we think it's really important to track the accuracy and try and improve that. So that's kind of one of the big things that we really see the sort of top startups, top finance teams doing.
Sorry to
Yeah,
interject there on that topic because that was interesting. I think one of the potential failure modes of planning as a concept in general is you create all this motion, right? So a new person comes in, they've worked at big companies, they implement something. It's this plan, there's OKRs, there's fancy meetings. And then it's like 2 months later and like no one's looking at the things. It really actually maybe was negative in fact, because people didn't accept the idea that, hey, we're a startup and things are going to change. So I'm curious, and not to go too deep, but curious, like, how do you think maybe at Causal or some of your companies, like the best companies kind of acknowledge the idea that a plan is just one intention and there could be many plans in the future, but also how to like build it into the culture that people care about this sort of stuff and are kind of going to check it on an ongoing basis. Does that make any sense?
Yeah. That I think that's a great question. It's definitely a big challenge. I think one thing which leads to this failure mode is often if the planning process is too top down. If it's like, hey, this like chief of staff or whatever, head of finance has come in, from like McKinsey or Goldman or something like that, and they're putting, we now have this plan, we've got these OKRs, whatever it might be, and now we all have to like listen to their OKRs and like stick to their plan. I think if it's very top down like that, then it's very rare to kind of get the buy-in from people on the ground about like, hey, this plan is something to be taken seriously. This is a tool to help us like on a regular basis make decisions. And so I think a big part of getting everyone actually paying attention to the plan and kind of thinking proactively about it is making it kind of a much more collaborative process where, at the high level, it's probably like the CEO plus the board that are setting the, super high level targets of like, look, we need revenue to 2x by the end of next year or 3x by the end of next year. But then kind of working with each team to figure out, okay, that's what we need to get to. Let's put together a plan on each team, on the sales team, like, sitting down with each team and kind of talking about, okay, look, based on this, how much pipeline do we need? Do you guys need to be spending more time on outbound? Like, how are we actually going to do this? And when it's coming from sort of people themselves, you probably get a better plan because the people on the ground have a good sense of like how things actually operate, and B, you'll have a lot more buy-in. And so I think just avoiding a super top-down process where you come in and just try and like throw these OKRs on top of a company that just hasn't been operating in that way. I think that's probably the biggest thing that'll help avoid that.
That makes a lot of sense. I think to your point, having a static PDF sent out to the company of like, hey, here's what we're doing in the future is probably just hard to kind of calibrate for. Actually having a tool, potentially like a Causal or whatnot, that actually is living with real data, with real insights, with different kind of simulations can make it a lot easier to actually stick to the thing,
right?
rather than just like have the motion in the beginning.
Yeah, exactly. And I think actually, I think you made a really good point in your intro that if someone is, if you're working at a startup, this is a pretty high risk thing to do. A lot of your, net worth will be tied up in the equity of the startup. And so it's actually in your best interest to have a really strong understanding of the health of this business that you're working for. I think I think all employees should pretty much know what the top sort of high level business metrics look like in terms of sort of revenue and burn and runway. Even if, let's say, you're an engineer and the work that you're doing day to day is a little bit far removed from revenue. Obviously, it feeds into it and it's crucial for the company, but you can't measure that pull request in the same way that a salesperson can measure the deal they just closed for the company's revenue, right? But I think just on a kind of on a personal or selfish level, you do probably want to have a good sense of how the business is doing, just so that you kind of know how much your equity might be worth, and kind of evaluating your own options. So I think there's actually a lot of incentive for employees to have an understanding of what a business's plan is and how the business is doing.
Makes a ton of sense.
I'd love to jump over more to the personal side of things. I'm just out of curiosity, like how were you always into sort of personal finance? Are you the kind of guy that's like tracking air miles and hotel points, or like, what was your angle coming into Compound?
Yeah. So actually not. I personally, I actually hate finance. So
Oh,
this
okay.
stuff gives me a lot of anxiety. It gives me a lot of stress. And my objective, and I think our objective as a company for a lot of people, is to help them not have to worry about this stuff. I think there's certain kind of personal finance apps that like send you a notification every 2 minutes to get you to kind of log into their app. Kind of our objective in a lot of ways is to kind of abstract this complexity from your life. So when you want to, of course, you can dig in and get into the weeds and see how the math works.
Yeah.
But in a lot of ways, you are paying us so that you don't have to worry about this stuff. And
Right. Yeah.
why I really got into it, frankly, is because I realized that this stuff is not particularly hard. And as you dove into a lot of the financial planning stuff, it's not like rocket science that you're doing, but it's also not particularly fun. And for myself and all of these, a lot of my friends and peers, I was really asking the question of like, should they really be spending all their time in the minutia, the administrative side of their finances, rather than working through an experience? I think like the one we provide today that is a lot more dynamic and designed kind of around your life rather than kind of the other way around. So that's a little bit of the background. Does that kind of make sense?
Yeah, for sure. So it's about helping people not have to worry so much about like the details of these things. But obviously, if you do want to, you can log in and see exactly what's going on with your finances.
Right. And I think part of our job, and I really liked your framing, but part of our job is to kind of help people make assumptions and risk they're taking more explicit. The
Okay. Yeah.
problem today is as people are investors of their time, also their money, and they want a return. The return can be fun, money, learning, impact, prestige, all these things. The problem in a lot of ways is they're not making this plan that they have explicit with the world. And it doesn't need to
Right.
be
Yeah.
a 45-year plan around how they're going to retire in Florida one
Yeah.
day, but more so, hey, this is what I care about today and this is what I don't. And the biggest problem we found is that a lot of people just don't know what they don't know. So that if we can make it more explicit and bring more transparency to how people are managing their finances, for example, not setting up a trust has this consequence, or not exercising stock options now has this consequence. And we can build tooling to dynamically model all the tax implications so that you don't have to, send 8 emails and get V8 of some status in the future. Like if you can make it not suck in a lot of ways, this whole thing can really help you obtain peace of mind faster. Does that kind of make sense?
Yeah, absolutely. So yeah, I think from the business side of things, we often think about like the ROI of different things. What's the ROI of spending this much on marketing or whatever, or making this higher? What would you say, if you're trying to think about personal finance in the same mindset, what are like the highest ROI things that people should be making explicit or thinking about, or making sure they get these few decisions right?
Yes. So the first disclaimer I'll give you is that tax lawyers don't rule the world. So there are things you can do. We'll walk through the acronyms, et cetera. But I think a lot of times when people are kind of optimizing their finances, they forget, that there's also this kind of life optimization, right? For instance, moving states to save money on taxes may save you some amount of money on taxes, but you may hate your life, right? And that would also not be particularly good. So I say that only because it can be fun to like talk about acronyms. Like I read books that you haven't read, so I can kind of scare you a little bit.
Yeah.
But at the end of the day, like focus on what really matters. Work with the people you really like. Live with the people you really like, and start there. Is like
Okay.
where it's
Yeah.
on that. There are things you can do, and depending on the type of assets you have, it changes kind of the types of things you can do. We particularly focus on people who work in the technology industry. So a lot of these people have assets that, frankly, in the United States are incredibly complicated to figure out how to manage. For example, you own stock options in your company, you're an employee who works at a private startup. When you decide to exercise your option, so exercise meaning purchase your shares of your company, you may owe taxes, right, before you get liquidity. Right, so it's quite a complicated calculation. We built a lot of tooling to kind of automate it, but it's quite a weird calculus because you're paying money to purchase this illiquid asset that's tied to your single source of income, that's rather opaque, that could go to zero, that you owe taxes for before you get any of the liquidity, right? And doing that sort of math is stressful and complicated. Traditionally, people, you talk to your HR, you talk to a financial advisor, you talk to a tax advisor, you talk to a lender, you talk to a lawyer potentially. We kind of do all of that to make that process simpler. But what a lot of people don't do is they don't go in and realize that they just, they're the smart person. They just signed an offer letter and they don't realize that X% of their compensation, which often is meaningful for a startup, is tied to this thing that they may not understand. So my advice to people there is go in and make a plan. What that plan can look like is, and I'll throw out some terms that I'm happy to dive into, but things like early exercising your equity if you're allowed to, where you have to file something called an 83B election, and there's a lot of tax advantages for doing that.
Right.
Another is being aware of the QSBS clock when you hold any of these assets. QSBS is the Qualified Small Business Stock Tax Exemption Clock, because you can get $10 million in tax-free capital gains at the federal level. So those are two things related to equity in particular that could make a difference. Now, the one thing I do want to add as well is we've kind of arrived at this state in the kind of economy today where, there's a lot of things going on, but one thing that's going on is this kind of unbundling of finance, where nowadays you see there's an app for every single thing you can do with your finances. But the challenge is that it's not particularly easier to manage your finances. And perhaps even more importantly, it turns out that you don't actually want to make local optimizations with your finances. In other words, exercising your options, when you're doing that, you should really be thinking about, what are you doing with the rest of your money? Do you want to have kids, get married, switch jobs? These are all kind of inputs into the equation. So comprehensive kind of holistic planning will always, in my view, at least yield better results than just optimizing in a silo without thinking about your broader financial picture. Do these things kind of make sense?
Yeah, somewhat familiar with 83Bs and QSBS, but I think the US options stuff for employees is just such a rabbit hole, and there's sort of tons of reading that people need to do to get up to speed with it. So anything that simplifies that process, sounds super valuable. I mean, how would you, I guess one big decision that's that will dictate people's finances quite a lot is which company they end up joining. From kind of the employee side of the table, how would you think about evaluating like a job offer from a startup, and how do you kind of think about cash versus equity, and some of these other things that you might not ask about in the offer, like can I early exercise? What would be your advice to someone who's maybe comparing offers or about to start a new job?
Definitely. So I would answer that question a few different ways, but I'd really implore that people think about this decision of their life just like, or very similar to how a venture capitalist would think about investing in a startup. Now, the difference, to make explicit, is that a venture capitalist has a team of analysts underwriting which companies they invest in.
Right.
Venture capitalists broadly care about making money. You may care about making money, but it may be one input. There may be others like quality of life, which can be correlated, but quality of life, or the type of company or the impact you're making on the people, et cetera. That's the second. And then the other thing is that venture capitalists diversify their investments across many, many companies. You, unfortunately or fortunately, can only work at one company at a time for the most part. And as a result, you don't get that kind of luxury. So what I generally recommend is a twofold approach. The first is that I think most people are pretty bad at underwriting companies. In other words, picking the company to work for based off of the market, how likely you expect the company to be successful, it's just a hard thing to do. If you're really good at that, consider starting a hedge fund. Maybe we'll fund you, but it's a hard thing to do. it's not impossible, and you should do some sort of assessment, and you should ask some questions, which we can talk through. But that's kind of one aspect of the underwriting process. The second, though, is that I think people generally are a lot better at underwriting people than they are companies. So I always implore people to basically look towards the people they'd be working with and think about, do you think they're going to be successful over X time period? And by focusing on that, I think you end up protecting more for the worst case scenario, which is that you work with a bunch of people you think are great. And also, more likely to get the best case scenario because you've met thousands of people in your life. You have a pretty good idea of who you think is going to be great. Maybe you're not right, but at least it kind of correlates with kind of your broader thinking. So that's a little bit how I think about it. I think on the question though, and maybe even to open the question to you a little bit, I'm curious how you think about communication about some of these numbers with people. I know we got kind of a question around actuals versus planning. I think as a founder, I feel that I have a duty of sorts to both communicate to my current team members, but also, as the company scaled, to former team members, and then also to investors and also prospects that may be joining our company.
Yeah, exactly.
I'm curious how you think about that kind of communication layer as it interacts with all these different stakeholders.
Yeah, for sure. I think I was quite fortunate that the first company that I joined out of university was just very big on sort of financial transparency across the business. I think so. I was there when the company was a few dozen people in size, and everyone would get all the employees would get BCC'd on investor update emails that had kind of the raw numbers of the business, what's going well, what's not going well. And so I think I was quite fortunate that there was just kind of a lot of transparency in that business. And so to me, that I think at the time, to me, that just seemed normal. Like, oh, cool, I'm working for this company. Of course, I should know like how much money we have in the bank and all of these other things. And so it's something we've always been in favor of at Causal. I think the way we do it, I think most companies have like all hands meetings, right, where you kind of talk high level about how different teams are doing, what's going on in the business. That's kind of our main checkpoint where we kind of update everyone on the health of the business. I think internally people might care about sort of different things than say investors care about. So I think there is a question of like, you can't spend the whole meeting kind of digging into all the numbers of the business. There are other things to talk about. So just kind of picking the top sort of 2 or 3 things that won't create this kind of numbers fatigue where actually people stop paying attention because there's just too many numbers going on. Just like the top 2 or 3 things. I think right now the things that would be top of mind for employees will be things like cash in the bank and runway and probably like revenue. So those are the ones that we share, at all hands on, every couple of weeks. Investors care about sort of a different set of metrics. But, we obviously use our own product Causal to have kind of a live dashboard where, even outside of these meetings, people can just go and check this dashboard if they do actually want to dig into things. So that's kind of been our approach. We'll kind of have to see how that scales as the company grows, et cetera, et cetera. And I think there is a danger of, you don't want people to be constantly like thinking about, oh, like what's our runway? Are we running out of money? Like, why is it this? Like, should it be longer? You don't want people overthinking these things. So I think there is a danger of sort of focusing too much. But I think just 2 or 3 high level numbers that people want to know is kind of how we do it.
Yes, that makes a lot of sense. I think to your point, and maybe to give some empathy for founders, it's not that founders want to necessarily be evil. It is that there is a kind of cost to distracting your team and showing them all these things that may actually not be great. There's also, I think a little bit of a challenge in terms of knowing what to communicate to candidates when you're hiring someone.
Right. Yeah. Do you share your revenue numbers, in the second interview or something? Yeah. Right. Yeah.
Right. And where we see that really come into kind of fruition, to kind of hop around a little bit here is that you end up often kind of compensate, when you get an offer letter, if you're an employee or an executive at a company, oftentimes we see a lot of our clients, they get an offer letter that they don't understand at all. And I found that just to be this like weird thing where you've got these like really smart people. They're like PhD machine learning engineers from the best schools and best companies. And they get this offer where they're purposefully taking a cash pay cut, right? They could go work at one of the big companies potentially. They're purposely taking a cash pay cut to get equity. And yet they're signing this offer for this equity thing that no one understands. And also like, they're not even asking, many questions about when they sign the offer. It feels like we've arrived at this like bizarre state in the world where like people are, getting 50% of their expected long-term compensation or more in this amorphous lottery ticket-esque
Yeah.
thing that people are afraid to ask questions about. I have some ideas around, how we can make that better, but like
Yeah.
that feels wrong to me too.
Yeah. Yeah, no, absolutely. I think part of the reason is that if you're applying for jobs, if you're like interviewing, it's so emotionally draining, it's so emotionally taxing that when you get to the end of the process, you almost just kind of want to be done with it, right? You don't want to then go through a whole other round of doing tons of diligence, and like maybe you take too long, maybe they pull the offer, all of this kind of stuff. It really takes it out of you. And so I think just the kind of relief of kind of getting to the end of a process with a company you're interested in, I think that's a big reason why often people don't dig enough into these things. I think one of the things that we do at Causal that I think candidates have found pretty helpful is that we basically present them kind of an interactive Causal compensation calculator. So we've built this like compensation calculator in Causal, fairly simple thing that shows like, hey, this is the cash component, this is the equity component, and a few different scenarios of like, look, if we exit for 1 billion or 10 billion or whatever it might be, this is how much your equity would be worth after a few more rounds of dilution and things like that. And so just kind of giving people an interactive tool that they can play around with to understand some of these different scenarios. I think we found people pretty appreciative of that, and it's been quite a useful tool. I know some companies have sort of spreadsheets that they might present with these kinds of scenarios as well.
Yeah, I think there's kind of like two categories of things. One is that, it's not your job necessarily as a founder to give tax advice or legal advice.
Right.
It's totally not your job to be doing that. On the other hand, though, you're hiring this person. You want them to feel motivated and incentivized to do the best work at the company, and them not understanding how their compensation works is also kind of a bad thing for you because you're giving them a meaningful part of your equity. So finding that appropriate balance through maybe a
Yeah.
calculator, like you're saying, or I think there's a lot of terms in the equity world like post-termination exercise windows that if you don't understand them as a candidate, it could mean your equity could be worth zero in the future.
Right.
And I think being kind of upfront about that sort of information can be really, really helpful to people. And I think perhaps an interesting segue to like a tricky question around transparency it can be a double-edged sword. And when things are going well,
Yeah.
it's great to write blog posts about your revenue numbers, but when
Yeah.
things aren't going as well, how do you lead with that same amount of integrity, and how do you think about communicating that component to people? I have some opinions, but curious like how you think about that.
Yeah, I think to some extent, if you live by the sword, you kind of have to die by the sword as well. I think one thing that like a lot of companies will be facing right now is, last year you might have raised this massive round, amazing valuation. The team's super happy. They've like their equity is worth like 4x in 6 months or something, right? Everyone's really happy. Now, obviously, in the current market, the thing that will be on people's minds is like, wow, we raised at that valuation last year. Is our company still worth that? Like, is my equity still worth what I thought it was? And how do you kind of communicate that? I mean, I think one thing is that there's a danger sort of kind of overfitting on the short term, right? Like things are always going to go up and down. There's going to be cycle, bear markets, bull markets. These things are always fairly cyclical. The way that we encourage our team and sort of candidates to think about it is, look, if you're taking this bet, you'll be joining Causal because you want to be here for the next sort of 4 to 10 years, right? And so whether or not the Series A valuation still holds up today or like next month or something, or whether or not the next round's valuation will be like 2x that or 5x that, whatever it is, right? The thing that you should be thinking of is like, okay, what could the terminal value of the company be, like 5 to 10 years from now? And by terminal value, we just mean kind of, once the company sort of breaks out and, assuming it does break out and sort of goes public or whatever it might be, like how big could this thing be? A lot can happen in the next sort of 5 years. There's going to be lots of ups and downs. But if you have a good sense of like, okay, I think this company could plausibly be worth like $10 billion, once we get to this kind of big vision that we have, I think that's what we encourage people to think about, of like, okay, how big could this be long term? And then let's think about how much my equity is worth. I think kind of checking day to day and like worrying day to day about, my equity is worth this much right now, et cetera, doesn't necessarily you can't really do anything about it in the short term.
Totally. Yeah. I think what I'm seeing often across companies is this pursuit of short-term thinking that in both in the good state of the world or in the bad state of the world ends up being really, really problematic. And I think if you're able to build a culture that values progress over motion, if you're able to kind of really articulate to the company around the long term of what you're building, and really pose kind of a long-term plan, it turns out like this stuff is maybe impactful, but if you're so long as you're committed to your long term, it may not make a big difference. I think people have the same problem where, as a individual, if I'm thinking about my money, it's very tempting to react quickly to the market and invest in all these random companies, and it's fun to talk about at the dinner table, but is it helping you kind of get to your long-term thing that you're trying to get to over time? And I think long-term thinking is just hard. It takes discipline. It takes patience. It's like words that are maybe incompatible with the move fast and break things mentality sometimes. So that's what I try to encourage our team and also our clients is, how do you run the scenario? And hopefully you can use tools that make this easier, but how do you figure out what your long-term is going to look like in both the best case and the worst case of the world? And then how can you really get excited by that part of the job?
Yeah, no, absolutely. I think it's super hard to think on sort of 10, 20-year time horizons, but I think that is probably what leads to at least the best outcomes. We've got a bunch of questions that have come in, so maybe we can start tackling some of these. So we have a question from Maria. Maria's saying that she thinks that you need to be transparent about performance and sort of actuals, like the actual performance of the business, before worrying about planning. I think this is absolutely right. You can't really plan for the future unless you have a sense of what your baseline is. If you're building a sales plan, you will need to have assumptions like, hey, what is our close rate and what is our average deal size and things like that. And to understand what those good assumptions look like, you do need a sort of pretty close sort of finger on the pulse of what the actuals are. So, what was the average deal size over the last like 2 quarters? And, based on, we now have like 50 customers. That's actually a decent amount of data to understand our close rates for all the prospects that we talk to. So yeah, I think getting accurate actual numbers is kind of the starting point before you build any plans. Curious if you have anything to add there before we move on to the next question.
No, I think that makes a lot of sense. I think, again, I would emphasize that I see planning, both in the personal sense, but in the company sense, can very easily be used as like motion. Basically, you could be in fairy tale land, right? So you create this plan that's like, I'm going to be a billionaire in a year, or the company is going to generate 200 million in revenue in the next 3 months. And it's like, who are you lying to, right? So I think that, maybe there's a better word for it, but starting with actuals, being pragmatic about your plan, not necessarily pessimistic. And I think that's probably the tricky part is, you're an ambitious person. You believe in yourself. You believe in your company. You want to achieve amazing things, but showing that kind of sensitivity analysis can really, really make a big difference, I think.
Yeah, absolutely. We've got another question. Question 2 is, as a founder, how do you balance maximizing growth while building out a solid business infrastructure from planning perspectives? Why don't you take this first?
Yeah, I mean, I think, well, what I'd say is, as a founder, when you're thinking about your personal finances, what I often tell people is, every second you spend not thinking about how to make your business successful, in other words, getting distracted by fancy estate plans or fancy tax plans or whatever it is, every second you spend not candidly delivering value to your customers in some way is a cost, right? And there's a big opportunity cost if this is worth X% of your net worth. And having fun doing this sort of stuff, while it could feel like you're making progress, it could be nothing compared to like making your company successful. So I really try to advocate for people in thinking through, like, do I need to add complexity right now? Because I think sometimes when they hear the word planning, they automatically default towards, I need to do a bunch of work. But I think what what I believe is like, actually, no, just write it down in a simple doc, or just say, hey, I'm not going to do anything right now, and here's a memo to myself around why I'm not going to do anything, because I want to minimize regret. Those are some things I kind of think about that question.
Yeah, I think that's a great point. I think people often have this image in their heads around what a plan looks like. Or I need to have a 5-year business plan, when I'm starting my company on day one or something. I think kind of the key is to try and think a little bit from first principles about, okay, look, how much of a plan is actually what I need right now, and like what level of detail do I need in my plan right now. I think as I mentioned, we've kind of seen lots of financial models, business plans over the past sort of 3.5 years of doing Causal. I think what we see is actually, I think in Europe there seems to be a bit more of a culture of like almost like business theater of like, building a business plan, all these things that, sound like what you do in a business before you have any customers, before you're providing value to anyone. So I think definitely avoid the trap of sort of over planning and kind of, have some basic process. Once that stops working, once you start to see, okay, we need to actually go deeper, then add that next layer of complexity. I'd recommend against kind of going too complex too quickly.
Yeah, and I think maybe segue into another question we got, which is like, when do you think as a company it's the right time to hire someone to manage the finance? I know some businesses like their first hire is kind of a CFO type of person, and other businesses make it to 10 million in revenue with no kind of
Yeah.
finance there. So
Yeah,
how do you think
exactly.
about finding the right fit for your business?
Yeah, I think the good thing nowadays is that you can actually outsource a big chunk of finance. So I think there's kind of broadly two buckets in which I'd put like the finance role. The first is more on the like corporate or strategic side of things of like planning, modeling, things like that. And then the second bucket is more operational finance of kind of keeping the lights on, making sure your books are accurate if you get audited, invoicing, more of the accounting side of things. And so I think you can keep the operational finance stuff outsourced for really quite a while, probably until the company's 50 to 100 people. You don't need like an in-house accountant doing that kind of thing. There's lots of firms that can help with that. We're 25 people at Causal at the moment. We'll probably get to say like 30 by the end of this year. We don't actually have a sort of dedicated finance person in-house. Obviously, maybe we're a bit different in that we are a sort of financial modeling tool. So this is something that most of our team are kind of clued up on. I think what we see is that once companies get to the sort of Series B stage, that's where there's a bit of a top-down push from investors to actually kind of get their books in order and have someone who really understands finance. And so we typically see, companies who are like somewhere between 50 to 100 people around the sort of Series B stage is when they hire someone in finance. I think the other consideration is kind of the complexity of the business. If you're a business that has like lots of different entities because you need to employ people in different places, if the way that you charge people is fairly complex because of your business model, you probably need to get a finance person sooner than if someone is if you run a SaaS company where all the employees are in office in one country, it'll be a lot simpler. So it does vary based on complexity, but I'd say like 50 to 100 people is kind of the sweet spot for most companies.
Makes a ton of sense. I do see that this problem of managing your finances, whether you're an individual or a company, does increase like exponentially as you increase the complexity of the business. And sometimes actually getting started early, like whether it could be lightweight, but like setting up the system, some system to track your balance sheet, for example, or your income statement or whatnot, kind of some core documentation can really prevent you having to clean up a big mess later on and
Yeah,
save you.
yeah.
So also getting ahead can be really useful, without adding too much weight, basically.
Yeah, for sure. And then, before that full-time finance person comes in, there will be finance that needs to be done, and it'll probably be the CEO for a bit, maybe a business operations person, maybe a chief of staff. And so kind of making sure that they're making the right decisions that'll help you, once you do hire someone full-time, be able to actually kind of work with those systems is pretty important. We've got a question from Greg about transparency. How do you stay on the path of transparency with things? I think we kind of chatted through this already. And we have a final question from, I think Kira is probably how you pronounce that. Is there such thing as too early to start providing teams with at least a max and min spend on items? When is the right time to start planning at a departmental level in terms of sort of budgets and so on? I can maybe go first on this one. I think it depends a lot on the company culture, I think. A lot of companies famously are very lax about how employees spend money. I think kind of Netflix, right, has this book, I think, called No Rules, Rules, something to that effect. And one of their big kind of values is that, look, when we hire someone, we give them a lot of trust. And we kind of trust that people will be sensible about how they spend the company's money, and they'll spend it as if it's their own money. And so, if that's kind of a really big cultural aspect at your company, maybe you don't need these kinds of explicit limits of like, you can spend this much, before it needs approval, et cetera, et cetera. I think it depends a lot on the culture. We are now starting to, so like I said, we're sort of 25 people. We raised a Series A about a year ago. This is probably the first time we're going through an actual planning and budgeting process where we will actually kind of carve out like, hey, this is how much we want to spend across each department. So we're kind of going through this for the first time now. I don't think we've really needed to until now. I think that the areas where it does become important is when you start growing headcounts, once you're above, say, like 20 people, you're going to be spending a lot of money on this stuff. And if your process is, someone just asks the CEO, like, hey, I think we need to hire this person. Is that okay? And the CEO is just evaluating each of these as like single decisions. That's where you might run into trouble and accidentally run out of money because you don't know how much you're spending on salary. So I think having a pretty strong sense of like salary is going to be everyone's biggest expense, and you do want like a fairly solid plan there. I think you can probably chill out a bit more on things like software and stuff like that.
Yeah, I think a lot of our clients, and also I imagine a lot of CFOs and finance people and founders that use Causal, they tend to be like pretty innovative people. They think about things through first principles, like they love innovating. But it turns out, I think at least, that a lot of like the finances, taxes, planning, all this stuff is actually not an area where you need to like invent a new paradigm.
Right.
Yeah. Like actually like doing the thing that's like saves you time is pretty good, is probably enough in a lot of ways. So I think one of the challenges that we have often is like people are very, wanting to like, well, could I invent this new way of doing this? Or,
Right. Yeah.
But it's like, actually like, don't overthink it. Like do the thing that other people say. And,
Yeah.
and the challenge is like, you don't want to do that about every part of your business, of course. Like for instance, our terms of service page is really pretty because we thought it was really important to make sure that our clients can understand it. So you want to kind of pick and choose, where to innovate, but sometimes avoiding that temptation to innovate for a reason can actually be
yeah. I think you should know when to think from first principles and when to just like do the thing that everyone does. So no, I like that a lot. Cool. Maybe just before we wrap up, I'd be very curious to hear like what's the biggest thing that people spend too much time on when it comes to personal finance? What's like the most overrated thing in personal finance that you think people should do less of?
Yeah. Well, I think there's this kind of complexity problem that basically appears across all of these events in your life. So for instance, when you want to set up a trust or file your taxes or exercise your stock options or any of these sort of events, these kind of local events, you end up having to like bring together this like mini family office financial kind of balance sheet, around that event. So what ends up happening kind of as your wealth grows is you end up doing that more and more often. You end up having to pay taxes every quarter. You end up having to like update your trust every so often. And all of this chaos stems from not having a financial system of record for your finances that's actually reasonable and accurate. So what I recommend people do in Compound, I'm biased in that Compound has an amazing balance sheet tool that integrates with your cap table and your cryptocurrencies and all of your documents and K1s. So you have one kind of balance sheet with all of your information. But actually, like, a lot of people are like, oh, I don't want to look at my balance sheet all the time. But the purpose of that, right, for a lot of our clients, actually not so that they can see a pretty visualization of their assets, which is one thing you can do with this, but it's actually because you can use that information to make everything else easier, right? Because that way you don't have to go get all this information every time you want to make one of these decisions. Right. You can actually just, really easily on Compound, just like one click and make all that stuff happen. So I would say spend a weekend or a few hours even building this kind of balance sheet, whether you use Compound or any sort of tool to do so. And that way you actually have a thing that if it's updated like ours, you can actually go make these decisions much faster in the future. Yeah. If you don't have that, it ends up being more of a headache to kind of do everything else.
Yeah, I've been surprised at just how hard it is to actually get something like that up and running. I think there's lots of tools where you have to do tons of data entry. Like I before kind of exploring this stuff probably like a year ago, I thought, oh yeah, this must be a solved problem. You just get this tool, it integrates with like Coinbase and the stock, whatever, and say, your bank account, et cetera, et cetera. But actually right now, my system is like a Google Sheet where probably like once a month or whenever I remember to, I kind of check it. I update my bank balance and check how much my crypto is worth and my stocks and update the numbers manually. So I think, something that kind of brings that all together would solve it.
Yeah, it feels like we like, and I said this before, but like we've got more apps than ever before. There's more
Yeah.
venture-backed fintech startups than ever
Yeah.
before. There's more things you do with your money, yet people don't know their net worth. And it's actually like a kind of a complicated problem, because if you think about your startup equity, like, well, what is your net worth?
Yeah, who knows?
Yeah. Or an 9A, or is it post-tax or pre-tax, or what if you move states? So the cool news is, like, we've built an internal tax API, so we can kind of like dynamically model out your tax liability as well. A lot of people, they think about their net worth and they forget that they owe taxes, so they don't actually know.
Oh, right. Yeah.
There is a lot of complexity, but I think doing that exercise, while it's not particularly fun, you'd rather be outside or whatever, can really like yield dividends over the longer term and prevent kind of creating a mess around your finances over the long term.
Awesome. I love it. Jordan, this has been amazing. Thanks so much. Where can people go if they want to find out more about Compound and potentially sign up?
Yeah, so you can go to withcompound.com. You can kind of request access, and kind of step one after you request access is we do kind of a free initial consultation. We kind of look at your financial picture, give you some advice. So that can be really useful. And then beyond that, we have a resource called the Manual. It's manual.withcompound.com. We do a bunch of free kind of events, information, really kind of well-written essays about all of these topics that are super normally scary to dig through. So I check that out as well. But yeah, thanks so much for setting this up, and thanks to everyone who tuned in.
Awesome. Yeah, thank you everyone for tuning in on LinkedIn and on Twitter. We will be sending out a recording to everyone who signed up for the event if you missed part of it, and looking forward to hopefully doing more events together with you, Jordan, and Compound in the future.
Awesome. Thanks so much.
Cool.